central banks around the world have been selling fiat currencies in order to buy gold. They have been cashing in credit, getting rid of those obligations in return for real money. I think we're about to see bond yields break higher. We're about to see stocks go down because they are already very, very expensive relative to Treasuries. The consequence of this is that the Fed is going to have to print. At some stage, people will move from thinking the risk-free position is to sell financial assets for cash so that I can sit on dollar cash, which is not going to go down, to realizing it's the purchasing power of dollar cash that is also falling, and therefore the only exit is to get into gold or silver. The largest holder of US Treasuries by group is Japanese institutions, not the Japanese government. We're talking about pension funds and insurance companies. They are the largest, far larger than China, who I think is second. It's very deflationary for the private sector, which really is going to be countered by being very inflationary. The first thing to understand or to recognize is what is credit and what is money. Credit is basically anything where there is an obligation to deliver something. So, for example, I'll take stocks, for example. You may be a shareholder. Now, if you're a shareholder, the management of that company has an obligation to deliver to you an income stream. So in that sense, your shares, if you like, represent credit. It is actually worse than that because you don't own your shares in this world of certificateless trading. That's all owned by a central counterparty. So as far as the company is concerned, their obligation actually is to you through the central counterparty. The central counterparty has an obligation to pass on that obligation, that credit, if you like, which is the other side of the obligation, to you. They actually own that obligation, if you like, from the company. So you don't own anything. So that's the first thing. If you have a deposit in a bank, it's exactly the same thing. There you've got two levels of obligation. You've got the bank's obligation to deliver the value to you on your deposit account. That's the first thing. But there is also the obligation of the central bank, which provides the currency in which that obligation from the commercial bank is denominated. So, in the case of Americans, you're looking at dollars. And if you think that dollars are actually money, just have a look at the Fed's balance sheet.
Your safest financial asset may actually depend on multiple promises surviving at once. As Alasdair Macleod points out here, stocks and bank deposits are layered claims rather than direct ownership, exposing investors to risks rarely discussed. Markets celebrate asset prices while ignoring the growing chain of counterparties beneath them. Wealth preservation begins by questioning what you truly own, not what your statement displays. Next, Alasdair Macleod reveals why the Fed's balance sheet exposes a contradiction most investors never examine.
The Fed is the issuer, not the US Treasury. And if you look at the Fed's balance sheet, you'll see that, yes, there is a liability on that balance sheet, and that liability is notes in circulation. There is also another liability on that, on the Fed's balance sheet, and that is what are called bank reserves. And those bank reserves actually are currency owed to the banks because the banks have deposits at the Fed, and it represents those deposits. So this is the way you track it down. Now, real money, if you go back to Roman times, has always been, and this is final settlement with no obligation on the other side of it. There's always been a physical, usually metallic form of money. And it evolved from bronze through silver and gold. And now, in these modern times, principally gold is regarded as the money. This is why the central banks around the world have been selling fiat currencies in order to buy gold. They have been cashing in credit, getting rid of those obligations in return for real money. It's still real money. Now, I know that for the last 50-odd years, the American administration have said, no, we've replaced gold dollars are real money and everything else refers to dollars. But actually, they're incorrect. They're selling you a lie. That is wrong. You've got to realize that everything you've got is basically in credit.
Central banks keep accumulating gold while publicly insisting fiat money remains unquestioned. According to Alasdair Macleod, the Fed issues liabilities, not permanent stores of value, making gold fundamentally different from modern currency. Institutional buying tells a story that official messaging rarely admits. Investors ignoring those actions may be trusting narratives instead of balance sheets. Next, Alasdair Macleod exposes why central bank gold accumulation contradicts decades of public monetary messaging.
Now that's fine. While the risk of that credit obligation, of those credit obligations, are relatively minor. But when they increase, which is the situation now, then you've got to start thinking about getting out of that credit and getting into real money. And this is why now for over a year I've been saying get out of credit and get into real money, which is gold and to a lesser extent silver. It's the only defense you really have. Now, I mean, so many people think you've got to diversify your assets. And so you put in 10% into gold or 5% or 1% or whatever, and you have some stocks, you have some bonds, and you have some housing and all the rest of it. No. What you are, if you've got, let's say, 1% gold and silver, you have 99% credit obligations. You are not diversified at all. The point about getting out of credit and getting into gold is getting out of risk, but you've got to recognize where that risk is. And that's what we're going to find out, I think, over the next 2 to 3 months. China is trying to sell all the dollars she can. Now we have Japanese institutions who are by far the largest holders of US debt stepping out of the market. You've got a debt crisis amounting in the US, and I can't see that 5% yields on the 10-year is going to stop it. I think it's, and if you told me, well, you asked me about how to, would 10% stop it? I'd say I wouldn't know. I don't think so.
Diversification can become an illusion when nearly every asset depends on the same credit system. What Alasdair Macleod is highlighting is that owning small amounts of gold beside mostly financial assets still leaves portfolios overwhelmingly exposed to counterparty risk. Foreign demand for US debt is weakening, while refinancing pressures continue building beneath the surface. Investors should focus less on asset quantity and more on the quality of ownership. Next, Alasdair Macleod reveals why rising bond yields could overwhelm traditional diversification.
Because it's a debt trap. This is the whole thing. The problem with a debt trap is the higher the bond yields rise, the worse the position becomes for a foreign investor, and indeed for a US institutional investor. The only solution to it is for the government to cut its spending and balance its budget. In fact, produce a surplus on its budget so that it doesn't have to raise any more finances out of the market. So I can't see that. You've got a spendthrift president who is engaged in one war directly and another war indirectly, which is being extremely expensive, both in terms of the spending on munitions and all the rest of it and troops, but also because of the consequences of it, the higher oil prices. And the other thing about it is that diesel is going to run out very, very soon. And this is crucial to all logistics. Diesel drives trucks, it drives trains, it drives ships, while in the form of bunkers, which is very close to diesel, because diesel is very close to being heating oil. So one way and another, this is not looking good. And I think we're about to see bond yields break higher. We're about to see stocks go down because they are already very, very expensive relative to treasuries. And the consequence of this is that the Fed is going to have to print.
A government cannot borrow its way out of a debt trap without eventually weakening confidence in its currency. Alasdair Macleod's argument suggests that higher bond yields worsen the debt burden instead of restoring stability. despite official claims that markets remain resilient. Rising energy costs and expanding deficits compound pressures policymakers cannot easily reverse. Investors face risks extending far beyond stock valuations alone. Next, Alasdair Macleod unravels why money printing may become the only politically acceptable escape.
And so, at some stage, people will move from thinking the risk-free position is to sell financial assets for cash so that I can sit on dollar cash, which is not going to go down, to realizing it's the purchasing power of dollar cash that is also falling, and therefore the only exit is to get into gold or silver. We're not quite at that point, but I think we're getting very close to it.
You mentioned along the way the Japanese central bank urging domestic funds or firms to take over their share of the heavy lifting of buying the Japanese debt. And you mentioned just a moment ago that Japan is by far the largest holder of U.S. Treasuries. So if they do follow suit at the apparent exhaustion of the central bank absorbing any further Japanese debt, that doesn't bode well for international demand for the U.S. Treasury. I think that's where you were going with that. Any further elaboration on that risk to the U.S. of that recent announcement by the Japanese central bank?
Yeah, well, it was actually the finance ministry rather than the central bank that made the announcement. Yeah, I mean, it's something. It's something which we'll work through. I mean, we've already seen the consequences on French government debt, the OATs, because we know that Japanese institutions have been big buyers of OATs in recent years. So they're obviously liquidating their position. And consequently, the yield on these OATs in the last month has risen by almost 0.5% in the last month alone.
When major creditors quietly change direction, markets usually recognize the danger long after institutions do. This is where Alasdair Macleod's thesis shifts from theory toward capital flows, pointing to Japan's changing behavior as an early warning signal. Bond markets often reveal stress before headlines acknowledge it. Savers relying solely on cash may discover purchasing power erodes faster than expected. Next, Alasdair Macleod exposes why foreign selling pressure could reshape Treasury demand.
Now that in these markets is actually quite a big move. So I think there's your evidence. And, it's not going to stop there. It goes elsewhere because, obviously you've got the carry trade, which is a large part of it. And the carry trade is probably all right at the moment insofar as it sees a weakening yen. When it sees rising interest rates then in yen, then it's going to have to start cutting its positions. But, at the moment, the largest holder of U.S. Treasuries by group is Japanese institutions, not the Japanese government. We're talking about pension funds and insurance companies. They are the largest, far larger than China, who I think is second. Or they may be third now, for all I know. China is dumping dollars as quickly as she can as well. So it's difficult to see, looking forward over the next month or two, how on earth the US is going to manage to not only fund its current deficit, but also the maturing bonds. I think we're looking at a figure like sort of $10, $11 trillion, which have got to be financed, over the next 12 months. This is a major problem, and it is mounting. So I would see bond yields going higher and higher. And when it comes to the price effect of what's going on in the Gulf, that's going to be very significant. As I said earlier, it's very deflationary for the private sector.
The biggest shifts often begin inside pension funds, not on television. As Alasdair Macleod points out here, Japanese institutions hold enormous treasury exposure, making their positioning more important than official government statements. Refinancing trillions in debt becomes harder if major overseas buyers continue reducing participation. That risk eventually reaches retirement accounts and household wealth alike. Next, Alasdair Macleod reveals why treasury financing pressures could spill into every financial market.
which really is going to be countered by being very inflationary for the government sector, because the government will create the credit to try and stop the economy and financial markets tanking. So where does it go? This is a huge, great dilemma, and it's all part and parcel of the end of the fiat currency era. I mean, the way you look at fiat currencies, the way you should look at fiat currencies, is that a fiat currency is used by government to increase its debt obligations without seeming to disadvantage its electorate. Its electorate are taxed at a certain rate. When you get over that, what you do is you print the difference. And it accumulates, and it's accumulated to the point where the US has now got about 40 trillion of its own government's debt. The question is, how far further can it go? What we're describing now is, if you like, a systemic problem of the major buyers of government debt, out of everybody else's inflation, if you like, credit inflation, are now coming to the end of the road. And the consequences are crash in financial markets, one, and secondly, crash in the value of the currency. It is literally, this is the end game for the dollar as a fiat currency, and you can also see how it's taking down the other currencies as well.
You wrote recently an article in where the opening statement is, "In the fog of war, truth is the casualty. Gold and silver prices will reflect uncertainty over outcomes."
Governments can postpone consequences, but they cannot eliminate economic arithmetic forever. According to Alasdair Macleod, expanding debt through newly created credit eventually pressures both financial markets and currency purchasing power simultaneously. The real danger isn't simply inflation, but declining confidence in the system financing it. Long-term wealth preservation depends on recognizing that distinction before sentiment changes. Next, Alasdair Macleod exposes why currency weakness and market instability increasingly reinforce each other.
All that traders know now, for now, is that bond yields must rise further. And later down in the article, you say today's markets are driven by sentiment and not fundamentals. This is to be expected in a credit bubble where greed dominates over caution. Can you give us a close-up of why people who are being told everything's fine, buy and hold, ride out the dips, buy the dips, that kind of thing, by their retail financial planners and the financial press, mainstream financial press, may be leading to a real fleecing, depending how things unfold going forward?
Yeah, I mean, there's a problem with the system. You have brokers who only really manage to survive by recommending stocks, not recommending to sell them, but recommending to buy them. And they continue to do it. And after years and years and years and years of seeing stock markets rise, and when they fall, they continue to rise afterwards, of course, everybody thinks, well, they're going to continue to rise forever. And that broadly is the sentiment about stocks in the US. But if you look at the relationship between the yield on the bond market, US Treasuries, and equities, that has become more stretched than it has ever been in financial history. In other words, this marks a bubble, quite simply, not only just in sentiment, but in terms of valuation.
Bull markets often appear strongest just before confidence begins quietly breaking apart. What Alasdair Macleod is highlighting is that investor optimism has drifted far beyond what bond market valuations historically justify. Financial incentives encourage buying regardless of underlying risk, reinforcing dangerous complacency. Investors who only follow sentiment may overlook warning signals already flashing beneath the surface. Next, Alasdair Macleod unravels why today's valuation gap resembles historic market extremes.
And this bubble is bigger, probably bigger, because we don't actually have the statistics to be able to show this, but it's probably bigger than the bubble in late 1929. So when this crashes, I mean, it's going to be the mother of all crashes as far as stocks are concerned. And where do you go? I mean, you can see, you then have to start thinking, well, what's the consequence of this? Foreigners selling dollars, because remember, they've got $22 trillion worth of investment in equities. And then you also get the investing institutions in America, realizing that they've got to lighten up on their own portfolios and the portfolios of the clients who they operate for. This is a scenario which could easily wipe out 90% plus of the value of the S&P 500 index. Easily, because you go from extreme optimism to extreme pessimism, and that's going to happen. So, it's that relationship which matters. And if we get rising bond yields from here, as I've just described, then it's going to break the equity market. It really will.
Extreme optimism has historically been the most expensive emotion investors could afford. Alasdair Macleod's argument suggests today's equity valuations remain vulnerable if rising bond yields force institutions and foreign investors to reduce exposure simultaneously. Market liquidity can disappear much faster than confidence returns during systemic stress. Protecting purchasing power matters more than chasing the final stage of a speculative rally. Next, Alasdair Macleod reveals the overlooked signal institutions monitor before major market reversals.